Major funding for these broadcasts has been provided by grants from New York Community Bank, M&T Bank, AmTrust Title, Customers Bank, Ariel Property Advisors, Capital One Bank, Sterling National Bank, Marks Paneth LLP, Meridian Capital Group. Additional funding has been provided by grants from Amerant Bank, AVR Realty Company, Bank of America Merrill Lynch, Briarwood Organization, B6 Real Estate Advisors, CBRE, Chase Commercial Term Lending, Chase Mortgage Lending, Citizens Bank, Collins Building Services, CPEX Real Estate Services, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties Handler Real Estate Organization, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Kilroy Architectural Windows, Matone Group, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Group, RPW Group, SJP Properties, Stonehenge NYC, TD Bank, Terra CRG, the Merengor Family Foundation, and these friends. Money for real estate. Where's it coming from? You heard of banks, you've heard of other things, but there are people called alternative lenders. Some of it's private equity, it's a variety of sources. So today I've assembled these three private equity or lenders to talk about what they're doing, what they like, and what they're providing capital on. My guests, they include Bruce Brunel, who is the co-CEO of Keysight Capital Partners.
Correct.
Mark Bahari, who's the co-founder and managing director at Emerald Creek Capital. And last but not least, our senior loan officer analyst, Jared Shockett, yes, of W Financial Fund. So W Financial has been in the business for about 16 years, I think.
2003, yep.
Okay. You've been in business for 10 years.
Yep.
And you guys have been in business for maybe 3 years.
3 years, correct.
Why are people going to alternative lenders like you?
I think that speed is very important in today's market. Being able to close on a deal quickly, whether if a bank's going to take 2 months to close and we can close in a week, it gives a big advantage, and it could help the borrower negotiate a better contract price for himself.
Is it that, or is it also that you're less regulatory oriented, people are looking at a different approach?
Sure, well that's part of it, right? I mean, there's less regulation on the private side, so we can close quickly because of that. There's also, we'll enter value-add situations where the banks might want to wait for the properties to be stabilized. So there's various reasons a borrower might come to us where we're sort of make more sense than a conventional source.
So let's talk about who's the typical borrower to you, what kind of asset it is, is if it's multifamily, is it retail, is it industrial, is it hospitality, all the other food groups. What are you seeing, and where do you like to see loans, and then what size loans do you like doing?
Sure. We like owner investors, operators. That's the type of borrowing partner we look for. We'll focus on multifamily, retail, office, or any combination thereof. Here.
And size-wise?
For our piece, and we're subordinate at kind of in the 50 to 80% of the capital stack, so we can be 5 to 40 million. Our sweet spot's probably more in the 10 to 20 million.
What do you mean by subordinate debt?
Always a senior lender in front of us, so they're providing the mortgage call.
So would you take one of these individuals as a senior lender and go behind them, perhaps?
We could. We hold everything on our balance sheet, and if they were doing the same, we certainly could work together. Yeah.
We do. For us, though, we're always senior secured, so we need to be in a first mortgage position.
Okay, so you're only doing senior loans.
That's correct.
And the type of loans that you're traditionally doing today?
The majority of our loans are acquisitions. It's an opportunistic situation, so we try to stay away from distressed situations where a borrower has a ballooning mortgage, property needs to be bailed out from his existing lender. We're really looking for the opportunistic situation. The borrower's looking to acquire property, maybe has a hard deposit. He thought the bank was going to come through on the acquisition, and now he finds himself potentially losing that deposit in a 2 to 3 week time frame.
I think we see a combination, a lot of acquisition loans on multifamily, retail, office, and then we also see loans where they may have a loan with a conventional bank and say it's a retail shopping center and they just lost their anchor and the bank loan is coming due. So they're in that period where they're about to go through a transition, they can't get another conventional lender, so they need a year bridge to, maybe fund TI to get a new tenant in before they could go out to the conventional market, so we could help them bridge that gap.
Hospitality is like the restaurant business. Each and every day you have to be in different operation, and its customer base is not stability. It's retail, but it's a harder retail, as one would say. Have you, or what's your interest in the hospitality? Because I noticed, I think you did something in the Bowery, something like that?
Yeah, we closed a few months ago a $40 million loan on Bowery. That had a hospitality component, but actually it was completed for 3 asset classes: residential, hospitality in the center, and then ground floor retail. On a selective basis, we'll look at hospitality, but we've now financed well over 300 transactions, and I think we've done less than 5 hospitality transactions.
And of the 300 transactions, what would you say the average loan size were, the average terms and conditions, so for my audience and the people who want to learn a little bit more about Emerald Creek?
Yeah, I mean, our average loan size is $5 to $10 million. Obviously, we go higher than that. I think our largest loan was $42 million. We'll go as low as $1 million. And if you look at our portfolio today, about 65 to 70% of our portfolio is secured by assets in New York City, with the balance in major core metropolitan markets throughout the country.
And you, Bruce?
We don't do hospitality. It's a heavy operations, as you were speaking to, and it's just something we're staying away from right now.
Same. We feel you really have to know the business, how to run a hotel. So we've done them in the past, but we don't seek them out, and probably just a handful.
Now, what about the ground-up development? Okay, let's say, like we were talking about in the green room before, you did this land acquisition on 2nd Avenue and 33rd Street.
At this part of the cycle, we prefer not to do ground-up construction. We feel that we're, at the tippy top. And if something goes wrong with a construction job, our thoughts are it's very difficult to manage. You have to deal with contractors, liens possibly being put on the site. Where we find that we're effective is if someone has to close on a piece of land just to lock it up. They don't have their plans yet, but we could allow them to close on the property, get their plans in order, and then they could redevelop the property with a construction loan and take us out at that point.
And you, Mark?
The same. We recognize, we're not in the first inning of the cycle, so when we're lending on land, it needs to be urban infill, and our loan-to-value needs to be around 50%.
I hate to say no again, but we do not look at land or construction at this point in time.
So let's talk about new players in town. We were talking about it before. 10 years ago when you went into business, 16 years ago, there were, I don't want to utilize the term, but sometimes people would say alternative lenders were called hard money lenders, okay? What has happened over the last couple of years, many owners, many developers have not been able to find properties that they like for themselves, and they said, I want to put my capital out, okay? Families like the Fisher Brothers, the Mac Real Estate Capital, and other people like that are putting money out. Are you seeing people who are trying to be competitors entering the market, and what's the nature and how are they trying to go after your business?
Sure. I mean, I think there's a tremendous amount of competition of late. A lot of people are very aggressive on dollars. You have plenty of, historically equity players that they can't find good deals to buy, so they're jumping into the lending space. And if they're willing to do 90% leverage, that's something that we just can't do. So we've had to compete on pricing. And there's no reason why bank rates should be going up and bridge lenders' rates should be going down. And that's been the trend the past couple of years. So I think that once a recession hits, and no one wants a recession, but if it does hit, a lot of these players will.
So, but you bring up an interesting point. We know that one day there'll be another recession. It's the question of when and what happens over there. Each one of you has a fiduciary responsibility. You have a fiduciary responsibility to the pension plan. You have fiduciary to your pension plans and other private investors, and you have individuals of high net worth. How do you protect yourself for that potential element of the next recession? How do you cover yourself? Do you take reserves on vacant land? Do you escrow the amount of interest up front? Bruce?
Well, yeah, I'll go first. In a real simple way, we focus on the first two things is the borrowing partner. We look at them, and there has to be a certain threshold there for us to do business. And if we're comfortable with that, then we look at the investment, the equity, and we underwrite it as an equity investor. So we really need to understand the collateral. So we spend a lot of times, those are just fundamental things, but we spend a lot of times on those two things. I'm not saying you can't get something wrong. That happens over time as an investor of anything, but that's where we spend a tremendous amount of time.
That's why you charge.
Pardon?
A certain price.
Exactly,
okay?
yes.
It's a risk reward.
Yeah.
Mark?
Yeah, I mean, very similar. I mean, we focus on the sponsor, but we focus very heavily on the collateral and our exposure to the value of that asset. So when a correction happens, which is inevitable, we want there to be a good cushion between our exposure to the asset and its underlying value. If you looked at our portfolio today, the average LTV in our portfolio is between 50 and 60%. So, we think we've built a good cushion there.
With regard to that, one topic that everybody is a little worried about, especially in the New York market and also the Florida market, is the question on the condominium world. Okay, how do you look at the condominiums? Because, there's the potential pied-à-terre tax that they're talking about, increase in the transfer tax and other situations, coupled with the fact that higher priced condos are hurting in general. People are looking around. How do you make a determination when somebody comes to you saying, look, I have this location, I'll give you the example on the 2nd Avenue. It's a perfect location for residential rental building or a condominium because it's also near the hospital and doctors like owning their apartments. How do you look at that?
I think it's very location specific. Generally, when we look at condo deals, we like to be very conservative just because it's not what we specialize in, but we do a handful a year, and we like to be 50 to 60% loan to value. The super high-end portion of the market, call it $2,500 a foot and up, we shy away from, but there is plenty of demand, we feel, in that $1,500 to $2,000 a foot market, depending on your location. So those we would definitely lend on.
Mark?
Yeah, I mean, we'll lend on what we call affordable luxury, the $2 to $10 million condominium sale. But like Jared, it's the $25, $50 million, $100 million units. There's a limited buying pool there, and if there's pressure in the financial markets overseas, that definitely affects.
I happened to be 2 days ago downtown in Lower Manhattan, and the number of condominium developments were huge. I couldn't believe the magnitude I'm seeing over there. And so you have a lot of that, and you also have a lot of hotel development, as well as certain retail, which is coming up, fringe retail, and then you have the large retail. How do you look at Lower Manhattan as a lender in the market? What's your comfort level? What's your thoughts about the Lower Manhattan market?
I mean, we're comfortable with Lower Manhattan. It's very sort of property specific and sponsor specific, but I mean, we think it's there to stay, and we're comfortable in Lower Manhattan.
Manhattan's Manhattan at the end of the day. It could be the Upper East Side or Lower Manhattan. You have people living here, you have people working here, and even though it may go through, some changes throughout the years, ultimately it's going to keep appreciating, in our opinion.
You've done, let's say, spec housing out in the Hampton area. How do you see the Hamptons in that market for housing and so on?
It's not something that we do very often, but we do have a lot of repeat clients.
Right, with sponsor, based on the sponsor.
Based on the
relation.
sponsor, and also it's based on its location. So if it's south of Montauk Highway, if it's on the ocean or on the bay, that's something that we would be interested in. And then aside from just the sponsor's experience, obviously the amount of skin they have in the game. So if they're bringing a substantial amount of equity towards that project, we would have an interest.
I noticed that you were working on a deal in Tribeca a couple months ago. How do you see the Tribeca market, because there's a change in the zoning, the Hudson Square area has become a different neighborhood. It used to be industrial, now you have Disney over there, you have Google, you have some other people, coupled with the residential. How do you look down?
I'd probably do some of the same comments to your, Lower Manhattan. We like all of Manhattan, and it gets back to case specific of the potential borrowing partner and the collateral, but we like it a lot.
Unfortunately, many times on my show, when we're talking about the city of New York, people only talk about 3 boroughs. There's a lot of hype and a lot of opportunities and different discussions about the Bronx. So I want your thoughts about the Bronx, and I'd also like your thoughts about how you would lend on a transaction that was, let's say, created in an opportunity zone, funded by an opportunity zone investor, because most opportunity zone investors in many cases are not sophisticated real estate people. They're people who have made money in the stock market, who are taking the gain and putting it in this way. And they're putting the money away for 8 years, and they don't have the sophistication. How do you see that?
My understanding is there needs to be a development play in those opportunity zones to take
Correct.
advantage. Construction is not something that we focus on, so we haven't really come across that many situations.
We're the same. I mean, we're not doing much construction. That being said, there are other things in the Bronx that we've done in the past. We have closed a bunch of deals in Staten Island as well. I think the Bronx is a little further along just because, you have the transportation access that's a little better, but there is upside in Staten Island too.
As you mentioned at the start of this conversation, we've been in business about 3 years, and so we have a very focused business strategy, business plan, and it's really just probably the three boroughs you said. It would
Right.
be Manhattan, Brooklyn, and Queens. So we haven't spent a lot of time looking at the Bronx here, a lot of good things, and I think it's not that it's a bad spot to be from an investment standpoint, it's just not where we're at right now.
What about healthcare lending? I was saying to you, I recently was out and I saw a transaction. It was an urgent care center facility. Urgent care, certain of them are owned by private equity, certain of them are owned by individuals. How do you look at that, where basically the revenues are determined by the insurance company reimbursement? I mean, you're looking to get paid on the loan, and you're looking for someone to take you out, okay? As somebody would say, I'm very happy when I get repaid because at least I'm protected. Certain people say, I'd rather keep the money outstanding. I have the philosophy I like getting paid. How do you look at different industries, healthcare in general?
So, right, we like getting paid back ultimately. We make a loan to build a relationship and then get repaid. Healthcare is more of a specialty use, so we don't do much of it. We see an aspect of it in that shopping centers have urgent care, and that's a very fast-growing tenant throughout the country right now. So plenty of shopping centers that we've seen have those as tenants, but hospitals and assisted living type use, they're really businesses at the end of the day. We're more real estate centric.
With regard to promoting, how do people learn about you?
Yeah, I mean, well, we have a dedicated employee focused solely on marketing. We host events. We try to speak on panels as often as possible. And
how important is social media to you these days?
LinkedIn's very important. We're not doing other aspects of social media right now.
Same. LinkedIn is, we'll blast when we do deals on LinkedIn, but the other ones, not really.
For your business, I'd say LinkedIn is the best. I'd say Facebook really has a limited, different type of audience. It's more of a personal relationship.
That's right.
I notice it myself when I promote my shows. People watch many times online from the LinkedIn situation. Sure. The websites are important. I know you have a significant amount of advertising in The Real Deal.
Yeah, we advertise in various trade journals. We think it's important to be out there just in people's minds.
I feel the best publicity is reputation, and when you've been around for a long time and you do the right thing by people, your name gets out there and people, speak to each other and there's word of mouth.
Let's talk about leverage, so you can get a higher return for your investors. Are you going to banks such as like the Centennial, the Ozarks of the world, or the Axios, which I think was the Bank of the Ozarks before, to leverage your transaction, or are you doing it directly without any leverage?
We'll do one-off deals, that we'll pledge, but we pretty much keep everything in-house.
Because I know you had a line at one time.
Yeah, we have a line, but not, more for cash management rather than to really boost the returns.
Mark?
Similar. We work with regional community banks. We'll close the transactions with LP equity, and then we'll backfill with some leverage on a transaction basis. But it's about 20 to 25% of our portfolio.
Bruce? No leverage?
No, really, the leverage in our system is when we team up with a senior lender, but that's not where you're going.
No, but you also do sometimes loans where you do the whole piece of the transaction.
We can do that as well, yeah.
Would you explain to my audience what you mean by doing the whole piece?
We would call it a stretch senior, for at least that's our terminology. It doesn't mean it's the marketplace terminology. But because if we're in the 50 to 80% spot generally, we can also do the 0 to 80%. So sometimes there's a need for those proceeds all the way up to 80, and the first senior lender is not willing or able to go very high up in the capital stack. So it makes sense to do kind of one-stop shopping with us. So that's what we call stretch senior.
Repeat borrowers. How often do you see that?
Quite a bit. There have been plenty of instances where the borrower probably can go to a bank, but because they've had a good experience with us and they know that we can move quickly and we'll give more proceeds than a bank, typically, they'll come with us for a short period of time and then refinance us conventionally.
Same feeling?
Same, yeah. It's been growing. We've now been in business 10 years. Last year, we did an analysis. 1 in 4 borrowers was a repeat borrower. So we hope that continues to grow.
So in that same vein, what's the typical rate on a transaction that you like? Not something that's off the cuff, that I was talking about, restaurants or, hospitality or vacant land. What is the traditional rate that somebody would pay you for a loan as compared to a bank, all three of you?
Our rates start at L500. Typical rates probably L plus 550, so roughly 8.
Okay, so LIBOR today is what, 3.5?
Like 2.5.
2.5.
2.5%.
Yeah. So the all-in coupon to the borrower, for our industry right now is between, I think, 8 and 9%.
And a fee?
Yeah, we charge an origination fee, because of competition, that's been compressed. The average fee today is probably 1%.
Jared?
Same range. We float over prime, but we shake out, between 7 and 8.5%, I'd say. And with points, same situation. They've been compressing.
Bruce?
Yeah, a similar kind of range here. We're maybe a little longer term. For our space in the marketplace, that subordinate debt piece, we like to go a little longer. So we certainly can go 5 years. We could go 10, not fixed for 10, but we can go much longer. So that's the one thing that might be slightly different, especially with the subordinate debt.
Right. I'd assume the two of you, your normal term might be 2 years max.
We're 1 to 2 years.
Right.
Yeah, usually it's 12 months with some extension options.
What's your thoughts about the industrial market today on lending? Have you been doing much, or have you seen? I know you have this large Red Hook.
We do. I think in the right locations, certainly in a very urban environment, we think that there's value there. When we leave the New York metropolitan area, we haven't lent on any industrial there.
We like industrial a lot, and with so many portions of Brooklyn and Queens being rezoned to residential, there's not a lot left. So when you have a good industrial site, demand is very high. If you're close to a highway, you can get pretty good dollars for it.
What about, emerging neighborhoods that we were talking about, the Newark, the Brownsville, Coney Island, areas like that, which haven't really seen themselves, but, gentrification has changed and the city is growing and so on. How do you look at different neighborhoods in different areas?
We've been seeing a lot in Newark recently. A lot of development opportunities. We're not doing construction, but we've done some multifamily renovation type deals in Newark. So that's probably, and the Bronx.
Yeah,
I know you're a 3-star.
we're really very focused on just that, so we won't go outside the business plan.
Okay, so here's the big question. A transaction comes into you. How does something get approved? Is it a formal committee? What's the procedure?
Typically, a deal will come in, and if we like it, we'll quote it. And once the borrower's on board, if there are 3 people in the loan committee, if we all like the deal,
So is it unanimous that the 3 people have to
we
like
all have to like it.
Mark?
The same. You know, we'll do our internal analysis, then we'll do our third-party reports, and then we'll review it. My partner and I will review it, and if
So you have a loan committee of 2.
of
He has
2.
3.
Yeah.
And Bruce, how do you do it?
A lot of similarities. There's Barry Seidel and myself. We'll look at things, and if we're fine with it, it does have to be unanimous, by the way. Then we also have a managing board, but it's not a formal process. But there is governance in a managing board. So
And the typical time, how long it'll take you to close a traditional loan as opposed to, something where all the documentation is there?
yeah, we can move fast because I mean if we need to, but generally 30 days plus or minus.
Mark?
Yeah, I mean, usually it's a 2 to 3 week closing process.
Typical a week to 10 days.
Okay. So I think in essence, we all agree that, alternative capital is a good source. It may be a little more expensive, but it aids in the transition. It helps out on a variety of things. And I think all 3 companies have a marketplace. You may be competing a little bit, each one of you, but good competitors
Friendly
never
competitors.
hurts. Okay. Friendly competitors never hurt. And I'm happy that Bruce, Mark, and Jared came here, and I'll see you next week.